Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, I'm going to be presenting 3 costing methods that are usually used to assign a cost to a product or service. We're going to be learning about absorption costing, variable costing, and ABC costing. So let's start with absorption costing, and the 2 ways that we can do it can be job order or process. So I know this is going to sound weird, but what we want to consider when we're doing absorption costing is that this one will have a long-term orientation, and it's going to be more of a gross margin approach. So here we're going to assume that the products cannot be produced without the resources provided by the fixed manufacturing overhead costs. And so what this means is that in absorption costing, we're going to be including all manufacturing costs. So let's start with the first method of absorption costing, which is going to be job order costing. This is going to be used when you have many different products produced in each period, and a product costing system is going to be assigning costs to a specific job. So we're going to be getting 2 important values over here. First, the overhead rate, which is going to be the estimated manufacturing overhead costs divided the expected total units of allocation. And then once you have that overhead rate, you're going to be multiplying it times the cost object's consumption of allocation. And so this is going to give some benefits of predetermined rates because it's going to help you estimate the total job cost sooner. Another one would be that your actual overhead for the period is not going to be known until the end of the period. And third, that the actual overhead costs can fluctuate seasonally, so this is going to be misleading. So if we had to do a set of steps in order to do job order costing, we could divide it into 7 steps. First step, it's going to be identify your cost object. Second step, it's going to be identify and track all of the direct costs. Third, you should identify all of the indirect costs. And then fourth, you're going to select a cost allocation basis for this indirect costs that we already identified. Fifth, you're going to compute the rate of indirect cost allocation. Sixth, you're going to allocate indirect costs into the cost object. And then lastly, you're going to compute the total cost for the cost object. So job order costing is going to include all of the manufacturing costs, but is going to be specifically useful when you have many different products. What if you have many units of a single homogeneous product? If this is the case, then we're not going to be using that method, but we're going to be using process costing. So this is the other type that we can do in absorption method, but it's going to basically accumulate costs by the department, and it's then going to be assigning them to a large number of identical products, and it will give also the same average cost per unit. So since it's going to be the same product, it's not going to be as hard, and you're just going to be splitting the cost around all of the departments that kind of put their hand in creating it. This method can be calculated using FIFO, so first in, first out, or also the weighted average method, which can be abbreviated as WAM. And this is going to be where units and cost will relate only to the work done in the current period. So the key thing that you should consider is that equivalent units will be the number of partially completed units times their percentage of completion. So let's say one department ended up completing only 50% of this product, then we're going to take the number of partially completed units that were left and multiply that by 50% because it only got up to 50% completion. For process costing, what my professor suggested is usually always use the weighted average method, but so for this, we're going to have to find the number of units and then the costs. So the weighted average method for finding the number of units, you have to take what I was telling you, the equivalent department of units in a specific type of department, so department X, and we're going to take the units that they transferred into the next department plus the equivalent units that they have in our ending work in progress. So what this aims to do is see how many units were moved from what department into another, because maybe if it's a 3-step process, you have to consider that some things were moving around from station 1 to station 2 to station 3. So you want to take all of the equivalent units from every department and find a thing so you're not counting over costs and repeating the same thing in those 3 departments. Then, once you have that amount of units per department, you're going to find the cost per equivalent unit in each department. So this is going to be the cost of the beginning work in progress plus the costs that were added during that period. And then all of that, you're going to divide it by the equivalent units of production that you already found in the first step. So basically, if we broke this down into 3 steps, you would have to compute the equivalent units for a department called department number 1. Then you would compute the costs per equivalent unit. And then lastly, the costs of the units transferred. So this is going to be the amount that you were transferring from one unit into the next one. So process costing or job order costing are both going to be 2 types of absorption costing, which is one of the costing methods that I was talking to you. The second type that I want to introduce is going to be called variable costing. And with variable costing, you're going to have the fixed manufacturing overhead with a short-term orientation. And here, it's not going to be a gross margin approach, but more of a contribution margin approach. And what this means is that the fixed manufacturing overhead costs will be incurred regardless of production. And in this case, only variable costs will be relevant. So using variable costs has some advantages. One of them is that fixed manufacturing overhead will always be incurred. And so this is more useful for CVP because it reduces the incentive to keep building up inventory. This one is also more used in decision-making in real life. So if this method is better, then why isn't everybody using it? The only disadvantage about this method is that it is not acceptable for reporting. And the expenses should be recognized in the same period as the related revenue, and here we would be going back to financial accounting. But basically, absorption costing will be very useful for financial accounting reporting purposes. This one, variable costing, is not going to be used for financial accounting, but it's way more useful for your decision making. And so one thing that you should consider is that this difference in the fixed manufacturing overhead will have an impact when you have inventory. So as I was telling you, if you get to a net income with an absorption method, and this one is greater than the net income with the variable method, this means that you have a lot of inventory that's being accumulated. But this relationship is going to be reversed as soon as the inventory is sold. And so what you can consider is that the relationship between product and sales, when production is bigger than sales, this is going to make inventory increase, and therefore absorption net income will be bigger than variable net income. If on the other hand, production is smaller than sales, you're going to decrease your inventory, and therefore absorption net income will be smaller than the variable net income. On the last part of the episode, I'm going to talk about a third final method of costing that's called ABC costing, or activity-based costing. This is going to be a costing method in which we're going to identify all of the activities in an organization, and we're going to assign the cost of each activity to all the products according to the actual consumption by each. And so this means that the model is going to assign more indirect costs or overhead into direct costs compared to other conventional costing methods like the variable or absorption method that we just saw. So keyword here is always going to be the activities, because we're going to determine all of the activities, and this will take up the entire cost of a product. And what this means is that it's optimal with tech or with things that have multiple processes or multiple costs. So it is way more accurate, but again, its downside is that it has a lot of work. And so it's going to be best when there are variances in consumption of resources or different uses, and this is going to affect the total amount of consumption. But first of all, we have to understand what is an activity. This is going to be an event that causes the consumption of overhead. And so you may have what is called an activity cost pool, which is going to be a cost bucket, kind of, where you're going to have all of the costs related to a particular activity, and then they are going to be accumulated. If we talk about activity drivers, these are going to be any factors or activities that have a direct cause and effect relationship with the resources that are being consumed. So first important step would be obviously identifying all of the activities, activity pool, and the measures. But then which other steps would you use for doing ABC costing? After you already identified the activities, second step would be assigning overhead costs to each of these activity pools. Then the third step would be computing the activity rates, and then fourth step would be assigning overhead costs to the cost object. The last and final step would be just preparing management reports in order to decide what this ABC costing is all about. So this one is traditional from other types of costing methods because traditional is going to allocate all of the manufacturing overhead to products by using a volume-related allocation or disregarding SG&A costs. So after I've presented you with all of these methods, you may be thinking, which one is the best one that I should use? Well, it all turns into which one is the more relevant for you. You have to understand on which assumptions your decision is going to be based. You have to know why those assumptions are going to be valid, and also if you change them, would it make a difference in this decision? Also, the last thing that I want you to consider is that you should be looking at also qualitative factors that are going to be changing this decision, because it's not only going to be about which method to use, but which one is going to have long-term or short-term implications, which one is going to be aligned with your ESG strategy, which one is going to be aligned with your risk and compliance regulations. All of these factors are going to be adding up into deciding which method to use and which one is going to be more relevant. So remember again, my decision about relevant costs are going to be all of those that are going to be future-oriented, they're going to be incrementing by the decision, and they're going to be impacting cash flow. Make sure that the costs that you're including, regardless of the method, are going to have all of your relevant costs. Because if they are not included or they are somewhere that may be changing, then this is going to put you in a harder position in order to decide which costing method is better for your company. If you like the episodes that I'm creating, make sure to share them with your friends that also want to learn about business, and you can also give me a review to support my content. I'll see you in the next week so we can keep learning more about managerial accounting.